allowed to put or required to put down, and the actual level of documentation, meaning whether it's 2 versus 3 years of tax returns, whether it's, if you've got a good credit score and you're doing a small enough loan, you can simply give us your pay stubs and W-2s and qualify, as opposed to somebody who's doing a loan at the same amount and doesn't have such a good credit score will have to give much more extensive documentation, which could lead to other issues when actually getting the loan approved. So credit score is very important. Keeping those scores high is extremely important. So how do we do that? Again, I don't know how many of us actually own properties or bought properties, but here are key things to look at when looking at your credit and seeing what you need to do to keep that credit score high. So the first bullet here is not as commented on as it probably should be. Limited credit history. So I'll give you a real-time example. I have a client right now, young guy, he's a doctor, he's 31, 32, finished his residence a couple years ago, making good money, makes $175,000 a year. You would think he's a shoo-in to get a loan. He has one credit card, and he has great credit scores. He's got a 780 credit score, which is a top-tier credit. He has one credit card, and that's the only credit card he's ever had. He has an American Express card with a $10,000 limit. And he's looking to buy a property for, I think, $700,000 to $800,000. He was declined for his loan because he didn't have enough credit. He had limited credit history. So the banks will not lend to someone who does not have an established credit history. So again, he's a doctor, makes good money, but he hasn't shown to lenders that he can carry several types of credit, several types of credit lines, and carry them on a sustained basis. So if you look at it from our standpoint, from the lender's standpoint, why would we want to give this guy a $600,000 loan when all he's shown us is he's had a $10,000 credit card since he was 19, and that's the only thing he's had. So he was a bit frustrated, which makes a lot of sense, but a lot of people don't come to these first-time homebuyer workshops and don't realize what they need to do. He said, hey, I'm a doctor, I've got good credit, why can't you do this? I said, sure, you are a doctor, and yes, you do have good credit, but the credit scores you have are based on very limited credit history. So that's very important. So my coaching to him was go out and you get these offers in the mail of 0% credit card, accept 2 of them and go out to dinner and take everybody out to dinner and charge them up. And carry some balances, doesn't mean max out the card, but use them and establish credit history. It's very important. A lot of first-time buyers don't realize it. It's a very important point. Excessive debt. So again, like I said to him, don't max out the cards because then you get into excessive debt. You got a $2,000 credit card, you owe $1,900 on it, that's going to bring your credit scores down. It's not showing that you're managing your credit well, so you've got to be very careful in doing that also. Slow payment. So if you carry a balance of $1,000 on a $2,000 card and you make your minimum $5 or $10 a month payment, let's say, for example, that shows slow payments, and it shows that maybe you don't have enough money to pay this off. You've charged up your card, you don't have enough money. That's not a good thing. That will bring your credit down. Judgments, there's really no way around that. If you've got judgments against you, you got to pay them. Past foreclosure or bankruptcy is in this current market is pretty much a death sentence for a loan. When we see that, we say, sorry, we can't help you, and we tell people to leave. And there's really no way around that. The only way around that is working to get it taken off your credit, and there are ways to do that. And again, I can give you guys I can line you up with some people that might be able to help, or at least give you some advice on that. But that bullet right there is very important. If you've got one of those, it's going to be very tough getting a loan. New credit accounts. So again, moving back to my doctor client, he's got new credit accounts, or he will have new credit accounts. So let's say he comes back a month from now and says, hey, I have 3 credit cards now. Let's do the loan. A month from now isn't sufficient. You've got to have, technically, you've got to have a year of credit worthiness and established credit lines that you've been paying on to be considered seasoned credit accounts. So new credit accounts for him, if he comes back a month or 2 from now, it's going to be tight. It's still going to be tough. So that's another key. Numerous credit application. What does that mean? So if I go and apply for 2 or 3 credit cards, and I go to 3 different dealerships and I apply for 3 different car loans, and I go to 2 different mortgage banks and I apply for 2 different mortgage loans within a couple of months span, that will guarantee bring your credit score down, because it looks like you are trying to access and gain access to credit and funds that's going to maybe overstretch you. So credit bureaus, not even the banks, credit bureaus do not like seeing that, and they will bring your credit scores down. That's another great thing to be very cautious to shop for a mortgage, shop for a loan, save on the car loan. Do that after you buy your house. And the credit card applications that come in the mail, maybe leave them alone. And again, it varies per situation, and I can give you guys some pointers on that. Errors. Now, a lot of people have credit errors. I had some on my credit report where things were being reported incorrectly. It said I had a 30-day late payment on a credit card, and I did not, and I called them up, and they took care of it, and they erased it. So you've got to be very careful. And monitoring your credit is very important. A lot of banks offer that. My bank does. A lot of banks offer a credit monitoring service. Sign up for it. Doesn't hurt. $20 a month, $10 a month. Sign up for that. It's a great thing to have. We spend a lot of time on this. It's that important. Credit scores are extremely important if you want to get a decent mortgage. But again, like it says here, it's not necessarily the end of the story. There's always things I want to do, and I went over. So there's other things specific to each situation, so reach out to me and I can give you some pointers on that too. How much money will you need? I'll put all these up here. How about this? All right, 3 times to ask this question. How much money will I need? When considering your down payment. So, this is tied in directly to how large of a purchase you're going to make. If you're buying $1 million house, it's safe to say you will definitely need 20% down. Just the way it is. There's really no way of getting around that. Again, back in the days of early 2000s, you could buy $1 million house and put 0 down. It happened. You didn't have to put anything down. That's all gone. You've got to put 20% down. If you're buying what we call a jumbo loan, a large loan, anything above around $700,000, got to put 20% down. But for most of us, first-time buyers, people getting into the market for the first time, buying a 4 or 5, 600K condo, in LA and Orange County, you can actually get away with doing as little as 3.5%. A lot of people didn't know this. What's Sayed had said earlier on the slide that I had given him is you can do 3.5% down for an FHA loan, called Federal Housing Administration is what it stands for. It's a federally subsidized loan program that basically allows you to do a minimal down payment, and the federal government will buy those loans from banks like us on the back end, so that we can, on the front end, give them out to whoever qualifies. The maximum loan limit, again, is $729,000 in LA and Orange County. So technically, you can find something for $750,000, put your minimum 3.5% down,